So let's go ahead and treat our home equity as a financial asset. Let's see if it passes these 4 tests. Is it liquid? Is it safe? What's the rate of return? And are the tax consequences beneficial? I'm going to approach these in reverse order. First, we're going to define what equity is. Slippery definition these days, isn't it? Okay? Fair market value. Is that what an appraiser says your home is worth? Probably not, right? Unless the appraiser is trying to buy your house, right? It's what somebody will actually pay. Less the loan, the difference is your home equity, okay? All right. Which mortgage is better? Now, you have to put on the blinders here, okay? Because I know these questions are going to feel a little uncomfortable. You're going to think, what's his agenda? My only agenda for these questions is, what is the tax consequence of home equity? Which is better, a $360,000 mortgage or a $150,000 mortgage from a tax standpoint, assuming they're both fully deductible? 360, right? Why is that? Greater interest expense. Interest, if it's deductible, if it qualifies as acquisition indebtedness or home equity debt, it's deductible, benefits us, right? Okay, a 15 versus a 30. We're going to look at fully amortizing loans. Here's a 15-year fixed rate loan. Interest expense after 5 years, assuming a 33% marginal tax bracket. There's the tax benefit after 10 years, and again, the tax benefit. Now let's look at a 30-year fully amortizing loan next to this and see how they compare. After 5 years, 33% marginal tax bracket, 10 years, tax benefit. So which one's better? From a tax standpoint, right? Okay? Fully amortizing versus interest only, right? Kind of sounds, where am I going with this? Okay, let's look briefly at this. Let's just draw a really basic picture, okay? Here's a 15-year mortgage. Here's a 30-year mortgage, okay? As we slide down the amortization schedule, what are we paying? What's under the curve? What do we pay less of over time? Okay, I. So all we've just said is that we've got a tax benefit over here because we're paying more I, right? For longer. Does that make sense to everyone? Now, what is an interest-only loan? The flatline mortgage. It's going nowhere fast. Let's look at it from a tax standpoint, okay? There's what we just went through. Here's the interest only, okay? Again, remember, it's not paying down. So here's the interest expense after 5 years. It's static. 33% marginal tax bracket, tax benefit, larger, right? Because we have more I. Same thing here, 10 years, tax benefit. So which is better, a fully amortizing loan or an interest-only loan from a tax standpoint? Interest only. Does that make sense to everyone? On a tax-adjusted basis, what's happening to a fully amortizing loan, by the way? Does it cost you more or less or the same over time? On a tax-adjusted basis. Amy? More. It looks like this. It's the exact opposite of this. Does everyone see why that is? People think when they have a fixed-rate mortgage, oh, the payment's the same over time. That's not true. The principal and interest amount is the same, but your tax deduction is dying. Your payment on a tax-adjusted basis, and we all live in a tax-adjusted world, is going up. Here, it's going up faster on the 15. Okay. Sorry if I get started. I may never end on that thought. Okay, you can see, passionate about what I do. The larger the equity position, the more adverse the tax consequence, right? The more principal reduction one engages in, either by schedule or voluntarily, the more adverse the tax impact, okay? So, does it pass the test? No, right? That's easy. Okay, what's the rate of return on home equity? What is the largest down payment we could make? 100%. If we took our tooth fairy money and looked around enough, maybe another part of the country, we could buy a single-family residence for $100,000, pay cash, right? What's the smallest down payment we can make? 0? Yeah. Under certain circumstances, that's still true, right? Good enough credit, certain type of documentation, etc. We might put 0 down. Do either of these, excuse me, have an impact on the ultimate value of the home? Is everyone there? Okay. Does the equity position in a home have an influence on the amount it's ultimately sold for? How would it have an impact? There you go. Did everyone hear what he said? He said as an investor, if somebody has equity, sometimes I can talk them out of some of their equity. What he's politely saying is, if somebody has a home that's free and clear versus mortgage to the rafters, somebody who's free and clear, he might be able to negotiate down the price of that home. Which actually, I appreciate you making this point. So delicately, too. I've never heard it so delicately. It's very nice.
I'm working on a deal right now.
There you go. Working on a deal right now. Okay. See? He's practicing what he's talking about. What he's saying is actually the more equity you have in your home, potentially the more adverse the ultimate sales price. It's actually the opposite of what most people think. Okay? Thank you for making that. Rate of return on equity is always 0. Does everyone see that? It's always a goose egg. Doesn't matter what the appreciation rates are. It's wholly independent. I have a client who, I guess it doesn't matter what his net worth is, but when I talk to him, he's buying stuff all the time. Not things, businesses. Doug, what are you doing? Oh, I'm buying this, I'm buying that. Here's what he says. It's controlling the asset that matters, controlling the business, the piece of property, etc. It does not matter to what degree you control it, just owning it. That's all that matters. That's all that matters. Okay? All right, so rate of return, flunks. Well, in terms of rate of return on your money, it doesn't matter. What I mean is, okay, if I go back here, whether I paid cash for the house or financed it to the hilt, it doesn't affect ultimately what the business or the home is worth. Okay? That's the point I'm trying to make. Okay, so is home equity safe? Okay? If I bury $100 in my backyard, is it safe? In a tin can that only I know where it's buried, I don't forget, nobody else ever finds it, blah, 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 blah. Okay? Is that safe?
No.
Why not?
Inflation.
Okay, inflation. Okay? Setting aside inflation, is it safe? $100 would probably still be there, right? Okay. What if I put that same $100 into my home? Not literally stuff it in the wall, but stick it in the mortgage. Is it more safe, less safe? The same? Huh? Somewhat safe, okay? If my house depreciates, is my home equity safe? Do I have any control over whether my house depreciates? To a certain degree, right? If I don't do maintenance on my home, I can affect depreciation, right? But beyond that, do I have control over the market at large?
You can sell.
You can sell. There you go, man. But still, once you're selling, because it's a down market, you've taken some sort of hit, right? And look, I'm a type A personality. I think I control everything. Unfortunately, I don't control this, right? I don't control depreciation or appreciation. What if I'm the victim of a man-made or natural disaster? Is my home equity safe? No. Now, most people will think initially, I've got a homeowner's insurance policy, okay? You can look at this later. It's laminated, so we won't hurt it. This is last summer. Katrina insurance woes also hit rich. It's an article about a $1.2 million home that's free and clear in New Orleans. The insurer paid 10 grand, and I'm sure that person going into the hurricane thought, I've got this $1.2 million asset sitting there. They thought it was cash. Did the insurance cover the equity in the home? No. That's not what it's for. It's supposed to rebuild the home. It's supposed to, right? So, is home equity as safe as you'd want it to be? Probably not. Okay, liquidity. Is home equity liquid? Okay, everyone's already there. Can I use it like an ATM? What if I have an urgent financial need? Can I just go get home equity? Now, you'd like to think yes, wouldn't you? If you had a home equity line of credit, you'd say yes. Okay, ask somebody who went through Katrina if they could draw on their home equity line of credit after Katrina hit. Guess what the answer is? No. Banks can suspend home equity lines of credit for any gall-darn reason. Any reason they want. They could pull your credit and say, I don't like how that looks. I'm going to suspend. Your house could be affected by a natural disaster, man-made disaster. Gone.